Chapter number 2, the accounting equation. Once again, this course is designed for 0452, which is IGCSE, and 7707, which is O level accounting. The objectives of this chapter are to explain the meaning of assets, liabilities, and owner's equity. I have discussed these in detail in chapter number 1 with you. I also gave a lot of examples, but I will cover this again in this chapter for revision. Explain and apply the accounting equation, okay? And then outline the double entry system of bookkeeping. We will just outline that. We will not go into the details because chapter 3 is all about double entry system. In this chapter, our main focus is on the accounting equation because that's the chapter we are covering in these slides. Moving on. Okay, what are assets? Anything that has value in terms of money, which is owned by the business and which is used to generate income or benefit to the business. Simple. In the last chapter, we discussed the example of a bakery, and I gave you an example of all the assets of a bakery. This time, let's take a clothing store as the example. So first of all, what do we need when we start a business? We need a shop in which we will set up our business. But you can also rent a shop. In that case, it is not your asset because then you don't own the shop. But if you buy the shop and it's yours, then it is your asset, okay? Because it has monetary value and it is owned by your business, and obviously it is providing benefit to the business. Next, you will require all of these things, okay? You will require maybe a mirror. That is also your asset because then customers can look in the mirror and see how they're looking with your clothes. The computer which you will use to manage stock or to make bills and all that. Then mannequins on which you will have your clothing on display. Then all these are your inventory. These hats, these bags, these t-shirts, this pant, these shoes. What are these? These are your assets because they are your inventory. These are the things that you have bought to resell. So this is also your asset. Even this lamp here, this bulb, this is your asset because it has monetary value, it is owned by the business, and it is providing benefit to the business. What else? Money in the bank account of the business is also an asset, and similarly cash with the business in the drawer. Maybe in this table there is a drawer and they have kept cash in it. That cash is also an asset. And then obviously a delivery vehicle. If you're delivering goods, if you're providing deliveries to customers, you will need a vehicle for that. That is also your asset because it's owned by the business, it has monetary value, and it is providing a benefit or helping the business generate income. So it satisfies the definition. That's why it is an asset. Moving on. These are the common examples of assets. Cash, the cash you have. Bank, the money in the bank account of the business. Machinery, motor vehicles, trade receivables. Okay, who are these people? These are those people to whom business have sold goods on credit and they have to pay us later. So we have to receive money from them on a later date. They are our receivables, trade receivables. You traded goods to them, you have to receive money from them later. Equipment, inventory, I told you what inventory is. Goods that a business purchases to resell. Premises. Premises is simply the place or building where the office or the business is located. Land, furniture, fixtures and fittings such as lockers, boards, anything like that. And then computers, I just told you what they're used for, etc. So these are the common examples of assets of any business. Liabilities. Liabilities are things that you have to pay back. The simplest examples are a loan from a friend, a loan from a bank, or any expense that is still unpaid. For example, you used internet in the last month. You haven't paid the bill or the expense of internet yet. It is unpaid, it is due. So obviously it's a liability. You have to pay the money back to either someone or to a business. Owner's equity, capital. The basic definition of capital is the investment of the owner in the business. What is capital? Capital is the investment of the owner in the business. Owner's equity and capital are the same things. It is just another term given for that. Moving on to the accounting equation. The accounting equation states that assets of a business should be equal to owner's equity plus liabilities. What is the meaning of this equation? This equation simply means that all the assets owned by the business are either financed by the owner or through borrowings, right? I will repeat it one more time. All the assets owned by the business are either financed by the owner, which is owner's equity, or through borrowings or taking a loan, right? These are the two possible ways. For example, if you want to buy anything, let's say you want to buy a machine, what are the two ways in which you can pay for this, or in which you can buy this? First of all, you can use your own money, right? Own money, which in that case will be called capital, or you can take a loan from someone to buy this machine, right? There's no other way. So all the assets that are owned by the business are either financed by the owner himself or purchased by taking loan from someone else. It might be a bank, it might be a person. So that's why we have designed this equation. Both sides of this equation should always be equal, right? Let's move on. Okay, so using the accounting equation, we can easily fill this table. We know assets, let me write this once, is equals to liabilities plus capital, which is also called owner's equity. So I will write in brackets OE just so that you don't get confused. Owner's equity or capital is the same thing. So if assets are 7,000, liabilities are not given, we can just write L, and capital is given, which is 5,000. We can easily find the liabilities. This equation is just like any mathematics equation. Okay, so if this is plus on this side, when I move this to the other side, this will become minus. So 7,000 minus 5,000 will give me liabilities. So my liabilities are equal to 2,000 in this case, and you can write it here 2,000. Now we can see that assets are worth 7,000, liabilities are worth 2,000, and capital is worth 5,000. So both sides are equal. Assets is equals to liabilities plus owner's equity. And you can also fill in the remaining ones by using the accounting equation. For example, for B, all you have to do is assets is equals to liabilities plus capital. Assets are not given, so leave it like this. Liabilities are 1,350 and then capital is 2,450. So you can add these. I think it will be, let me check, 2,500, 26, 27, 28, yeah, 3,800. So very simple and straightforward. I'm using the accounting equation to find the unknown item. And you can also do the third one on your own. It is basic stuff. So I will erase this and move on to the next slide. The double entry system of bookkeeping. Okay. In simple words, when any business event will take place, it will have a dual effect on the accounting equation. Okay, a dual effect. I will tell you that in detail. One side of the equation represents all the assets and the other side represents the liabilities and owner's equity. Both sides should be equal. I have told you all that. This will be discussed in detail in chapter 3. The double entry system will be discussed in detail in the next chapter. I will make the video of that chapter after this. So don't worry about the double entry system for now, but just remember that any business event or transaction will have a double impact on the accounting equation. I will show you how. Let's see. Now, let's look at the following transactions and then identify the effect on the accounting equation. For now, we know the accounting equation is assets is equals to capital plus liabilities. Okay, we are starting a new business. So for now, all of these are 0, 0 and 0. Okay. Let's read the first transaction and then make the impact of that transaction on the accounting equation. January 1, Andrew started a new business. So who is Andrew? Andrew is the owner of the business and set up a business bank account and paid in $10,000 as capital. So what is Andrew doing? Andrew is investing $10,000 into the business and he has put that money in the business bank account. So okay, what is the business bank account out of these three? Is it an asset? Is it a liability? Or is it capital? Obviously, I have told you that the business bank account is also an asset of the business. So we will record this 10,000 on the asset side, and I've written in brackets bank so that we remember that this 10,000 is in your bank account. Okay, capital also changes from 0 to 10,000 because of this transaction, and there is no impact on liabilities because we did not take a loan from someone, so liabilities did not increase, right? When you take a loan, then liabilities increase. When the owner invests his own money, that is called capital, and this is what has happened in this. So assets have increased by 10,000 and capital has also increased by 10,000. There was no impact on liability. So as you can see, there was a dual impact, right, on the accounting equation. Assets increased and capital also increased. So two effects for every transaction. Okay, let me erase this and move on to the next slide. I will take this forward. Look at this: assets 10,000 bank, capital 10,000 and liability 0. I will move this forward to the next slide and then look at the next transaction. Okay, so this is here from the last transaction. Now let's read the second transaction and show the impact on the accounting equation. Jan 2. The business purchased a motor vehicle worth $2,000 and paid by check. When you pay by check, you know what a check is? Check is a business document used to make payments through your bank account. You might have seen a check, right? We write a check to make payments through bank. So check simply means you're paying through your bank account. Okay. And what are we purchasing? We are purchasing a motor vehicle. Again, what is a motor vehicle? It is an asset of the business because it has monetary value, it is owned by the business, and it provides benefit to the business. So as we can see, motor vehicle, which is an asset, is increasing in the business because you're buying it. By how much is it increasing? It is increasing by 2,000. But at the same time, you're paying by check. Check means you're paying through your bank. Bank is also an asset. So bank is decreasing by 2,000. Again, there was a dual impact on the accounting equation. Okay, one asset is increasing, which is motor vehicles, and the other asset is decreasing, which is bank. So that's what I have done. I have reduced bank to 8,000 from 10,000, as you can see, because we have paid 2,000 to buy the motor vehicle. And then there was no motor vehicle in the business. Now we have a motor vehicle. So asset side pay, I have included motor vehicle of 2,000 as well. Overall, the assets are still equal to 10,000, right? 8,000 plus 2,000, it is still 10,000, but we have traded one asset for another. Okay, capital remains the same because there was no other investment from the owner in this transaction. Did the owner invest anything? Is anything mentioned like that in the transaction? No. So capital remains the same, and we did not take a loan from someone, so liabilities also remain the same. There was a dual impact on this equation because of this transaction as well. Assets increased, and at the same time assets also decreased. This is also a dual effect, okay, on the accounting equation. It can be on the same side as well and of the same item as well. So don't get confused. It is still a dual effect because one asset has increased whereas the other asset has decreased. Let me erase this and move on. Now I will copy this to the next slide so that we continue from here, and then we read the next transaction and make the impact on the accounting equation. Okay, moving this forward. This is where we are. We have 8,000 in our bank. We have a motor vehicle worth 2,000. Capital is 10,000 and liabilities are 0. Now let's read the third transaction. On Jan 3, Andrew purchased inventory worth 200 on credit from SA Motors. Okay. So we are taking something on credit. Credit means loan. We have to pay them back later. It is a liability. So SA Motors becomes our liability. We have to pay them back later. We don't write liability, we write the name of the person or business who is giving us something on credit or who is giving us the loan. Okay. And what did he purchase? He purchased inventory. What is inventory? Inventory, I told you previously as well, it is an asset. It is the things that we buy to resell. Okay, so it is an asset. So as we can see, our asset is increasing by $200. Which asset is increasing? Inventory. And our liabilities are also increasing by 200 because now we have taken a loan. So our liabilities are 200. Our liabilities were 0, but now they are 200. So liabilities are increasing. Okay. Let me erase all this and continue with the impact. So let's see, bank was 8,000, bank is still 8,000 because there were no changes to bank due to this transaction. Nothing is mentioned about the bank. Again, motor vehicle was 2,000, it is still worth 2,000 in the business. Did we buy any other motor vehicle in this transaction or did we sell the motor vehicle? No. So no impact on motor vehicle. But now we have another asset which is inventory in our business because we have purchased inventory worth 200. So I've shown that on the asset side. Capital is still same because no further money was invested by the owner in the business. Did he invest anything in the business in this transaction? No. So capital is the same, but now liabilities have increased from 0 to 200 because we have taken a loan of $200 from SA Motors, and I have mentioned that in brackets below. Okay, erasing all this, moving this last one forward to the next slide. Okay, so this is the impact of the last transaction. This is how our accounting equation looks like right now. Let's read the next transaction. The business sold inventory worth $100 and received cash. Now you know inventory is an asset and cash is also an asset. So in this transaction we are talking about two assets. One asset is decreasing whereas other one is increasing. Inventory is decreasing. Why? Because you're selling it off. Right? So inventory हमारी कम हो रही है. Inventory will be reduced because we are selling it. Whereas cash will increase because we are receiving cash. When you sell something, you receive cash, right? So received cash means cash will increase. This is the dual effect. This is again a dual effect on the accounting equation. One asset is decreasing and the other asset is increasing. So let's make the changes and look at them. Bank will remain the same. Motor vehicle will remain the same. Inventory will be reduced to 100 from 200. Why? We had inventory worth 200 in the business before this transaction. When you sell inventory worth $100, how much inventory will you be left over with? We will be left over with $100 inventory, and that's what we have done here. We are left over with $100 inventory. From 200, now we have just $100 worth of inventory in the business. But cash is also coming into the business because we have sold it and we are getting cash. So I will include cash on the asset side as well because cash is an asset. Capital remains the same. Liabilities remain the same because nothing is mentioned about investment of the owner or taking a loan in this transaction. Let's move on. One second, let me erase this. Okay. Moving that accounting equation further, we were at this accounting equation right now. This is the condition of it. Now let's read the fifth transaction and make changes to the accounting equation based on that. Jan 5, the business paid SA Motors. SA Motors were our liabilities, right? We owed 200 to them. We owed how much? $200 to them. Now we are paying $100 out of that by check. So your liabilities will reduce to 100 because The loan that we were supposed to pay back was $200. We are paying 100 now. So leftover liabilities should be $100, and that's what I have done. I have changed the liabilities to $100 from 200 because my liabilities are decreasing. When you pay off a loan, your liabilities decrease because now you have to pay them back a lesser amount than the previous amount. So liabilities are decreasing from 200 to 100. There was no impact on capital. And how did we pay? We paid by check. Check means you're paying through your bank account. So you had 8,000 in your bank account. When you're paying $100 back, it means that your bank account will be left over with $7,900. So what happened in this transaction is that one asset, which is bank, decreased because you paid $100 from your bank account, and a liability also decreased because you're paying back a loan. When you pay back a loan, your liabilities decrease. So this was the dual effect on the accounting equation because of this transaction. Motor vehicle will remain the same, inventory same, cash same, capital same. These two things were impacted. Okay, erasing everything, moving on. Now, what is a statement of financial position? A statement of financial position, in simple words, is a list of all the assets owned by the business, all the liabilities that you have to pay back, and the capital of the owner invested into the business. So let's list our assets down by looking at the final accounting equation. Let's move back and see this. Assets, we have 4 assets in our business right now. We have bank 7,900, we have motor vehicle 200, we have inventory 100, and we have cash 100. So I will move these 4 in the form of a list to my statement of financial position. Let's move these 4 and see. Yeah, this is how you will do it. You will write down assets and then you will list all 4: bank 7,900, motor vehicle 2,000, inventory 100, and cash 100. When you add all these, you will get total assets, which is 10,100. Now moving on, let's go back and see the value of capital. The final value, it is 10,000. So I will come back to my SOFP and record the value of capital as 10,000. Okay, we have 2 headings in this. The first heading is assets, and the second heading is a combined heading of capital and liabilities. Why? Because SOFP represents the accounting equation. What is the accounting equation? Accounting equation states that, one second, let me change the color. Yeah, accounting equation is simply assets is equals to capital plus liabilities, and that is what we have to show in the SOFP. So we are totaling the assets here, and then we will total the capital and liabilities and see if they are equal or not. Okay, moving back to check the liabilities. Capital is 10,000, we have recorded that, and liabilities in the final step were 100. Okay, this is the final thing, right? This is the final accounting equation. This is the impact after all the transactions. So this is the final amounts. Sorry, these are the final amounts that we have to move to the SOFP. So liabilities are worth 100 only. So I have moved that here. Trade payables, these are those people who supply goods to us on credit and we have to pay them back later. So SA Motors 100. So total of capital and liabilities is 10,100, and total of assets is also 10,100. So we have proved the accounting equation. Assets is equals to owner's equity plus liabilities, or assets is equals to capital plus liabilities. It's the same thing, and we can see they're equal, which means we did not make any mistake in recording data. If they were not equal, it might mean that we have made a mistake. Okay, because both sides should always be equal of the accounting equation, and total assets should be equal to total capital plus liabilities. Let me erase this and move on. Drawings. Okay, a new term. Whenever the owner invests money into the business, we call it capital, right? Let me change the color. This is not looking nice. One second. Okay. Whenever the owner invests money into the business, we call it capital. Capital is money invested by the owner, investment. of the owner. Okay. What are drawings? Drawings are the goods or the money that the owner takes home from the business for personal use. Okay. If the owner withdraws something out of the business for personal use, we call it drawings, and we have to record that. You cannot simply ignore it. If the owner is taking cash home from the business, you have to record this in the books of accounting. You cannot say that, okay, it belongs to the owner, so let him take it home and there's nothing to worry about. No, the business and owner are kept separate in accounting. They are both separate entities and we cannot consider them as one. So if the owner invests in the business, we also record that as capital. So when the owner will withdraw something such as cash or any other good such as inventory from the business, we will record it as drawings. And when the owner invests into the business, we add it to capital. For example, the owner invested $1,000 into the business. What will I do? I will record it as capital of 1,000. Okay. And then let's say the owner withdrew $200 from the business. इसने क्या किया? He made a drawings of $200 from the business. So what should I do? I will subtract it from his capital invested. In accounting, we don't use the minus sign like minus 200. We simply put the negative terms inside brackets. So, drawings are always deducted from capital and then the capital will be reduced to 800. This is what we do in accounting. Remember that, okay? Drawings reduce the owner's equity. And it makes sense, right? Because when the owner invests, we record that in capital. When the owner takes something home from the business, we deduct it from his capital, his or her capital. Okay, erasing this. Effect of transactions on assets, liabilities, and owner's equity. This is in detail the impact of transactions on the accounting equation. I told you there's always a double effect. And we will see that in this example. Okay, read these transactions one by one and tell me which things will be affected and will they increase or decrease. I will just make an arrow upwards to show increases, an arrow downwards to show decreases, and I will just make a dash like this to show no impact, no effect. Okay. The owner introduced 45,000 cash into the business bank account. What is cash? Cash is an asset. Asset is increasing because cash is coming into the business. Our assets, which is cash, will increase. Did we take a loan or did we repay a loan? No, so there's no impact on liabilities. And the owner is introducing this money. When the owner introduces money into the business, it is called capital. So capital is also increasing. So this is the dual effect of this transaction on the accounting equation. Moving on. The business bought goods. Okay, what are goods? Goods is another name given to inventory. So we are buying inventory on credit from Sully and Sons. Okay, inventory buy कर रहे हैं हम. We are buying inventory. So assets are increasing because inventory is an asset. Liabilities are also increasing because you're buying these goods on credit. So you're taking a loan in a way. You have to pay back. So liabilities are increasing and no impact on owner's equity because there's nothing mentioned about the owner investing something in the business. C. Benjamin, a friend of the owner, lent business 3,000 in cash. So Benjamin is a friend of the owner and he's giving us a loan of $3,000 cash. So when we are receiving $3,000 cash, cash is increasing in our business. Cash is an asset. When assets increase, we will show it like this. Okay. Liabilities are also increasing because he's giving us a loan. He's lending us money. So liabilities increase and then no impact on the capital. Moving on to D. The business sold goods. I just told you goods is another name given to inventory. So don't worry about this. Inventory and goods are the same thing. So we are selling inventory for cash, $500. So inventory is going out of the business, which means inventory is decreasing in the business. So we will record it like this to show that assets are decreasing. But at the same time, we are receiving cash for it. And cash is also an asset. So cash is increasing in the business. When assets increase, we show it with an arrow upwards, or we can write increase. So one asset is decreasing, which is inventory, and one asset is increasing, which is cash. No impact on liabilities, no impact on capital. The business paid Benjamin 3,000 by check. I told you, whenever you see the term check, it means you're paying through your bank account. Okay. So money in the bank is decreasing. When assets decrease, we have to show them with an arrow downwards like this. And we are paying a liability. When you pay a liability, when you pay back a loan, your liabilities decrease. So we will show it with a downwards arrow in the liabilities column, and no effect on owner's equity. The business returned goods, $50 to Sully and Sons. Okay. When you return goods, which is also called inventory, when you're returning inventory, is inventory increasing in your business or decreasing? It is decreasing. You're returning some inventory back to someone from whom you have purchased it. So inventory is an asset, inventory is decreasing, so assets are decreasing. And Sully and Sons, we purchased this, I think, on credit. Let me double check. Yes. So when you are returning goods to them, means you are not going to pay back these $50 to them. So your liabilities will decrease by $50. So we will show that with an arrow downwards. No impact on owner's equity. The owner withdrew $400 from the business bank account for personal use. First of all, the owner is taking home money from the business. I told you these are called drawings, and they reduce our capital. They are deducted from capital. So I will make an arrow downwards to show the impact on capital, that the capital is going down. It is decreasing in value. No effect on liabilities because we did not pay a loan or we did not take a loan from someone. So no effect. And then the owner is withdrawing $400 from the bank account of the business. So bank is an asset. Money in the bank is decreasing, so assets are decreasing. Okay, H. The business bought a motor vehicle $4,500 paying by check. Okay, so business is buying an asset. Motor vehicle kya hai? It is an asset. So assets are increasing because motor vehicle is coming into the business. And at the same time, you're paying by check, which is payment through bank. So your assets are also decreasing. No impact on liabilities, no impact on owner's equity. The business paid a creditor $58 cash. Creditor कौन होते हैं? Trade payables. Those who have provided goods to us on credit and we have to pay them back later. So trade payable को we are paying back using cash, which means cash is decreasing in the business, which is an asset. So assets are decreasing in the business, and at the same time liabilities are also decreasing because we are paying back a loan. No impact on owner's equity. So this is how we show the double effect on the accounting equation. If you notice, there are no more than 2 arrows in any of these and no less than 2 arrows. So there's always a dual effect on the accounting equation because of the transactions. Okay. Moving on. Let me erase all this. Types of assets. We have 2 types of assets: current assets and non-current assets. Current assets are those which are usually consumed or used within one accounting period. Accounting period can be of any 12 months. It is not necessary that it is from 1st Jan to 31st December. No, it can be any 12 months because a business never starts on a fixed day. Okay, any business can start anytime. So any 12 months from the day the business started is an accounting period. So any asset that we have or we bring into the business with the intention of using it within 1 year is a current asset. For example, cash. The cash that we keep in our business is usually consumed within 1 year. At least that's our intention, to use it within 1 year. Otherwise, if that was not the intention, we will just invest it somewhere, right? Similarly, money in the bank for same reasons is a current asset. Then we have trade receivables. These are those people to whom we have sold goods on credit and we expect them to pay us within 1 year, right? We will not give them things on credit and hope that they will pay us after 1 year, right? We want our money as soon as possible. So our intention is to get that money within 1 year. And then inventory. Inventory are the goods that you buy to resell. So obviously you buy the goods with the intention to sell them during one accounting period. You will not buy excessive inventory and then pay storage cost and all that. So our intention is to sell it within 1 year. These are the common examples of current assets. Non-current assets, on the other hand, are those which are purchased with the intention of using them for more than one accounting period. Okay, for example, a motor vehicle. When you buy a motor vehicle, your intention will be to use it for a lot of years, let's say 4 or 5 years at least, right? So a motor vehicle, land, building, or the shop in which you are operating, all those are also non-current assets because your intention is to use them for more than 1 year. Other examples can be fixtures and fittings, the lockers you have, and the air conditioner, any equipment, any machinery. All these are purchased with the intention of using them for more than 1 year. So these are your non-current assets. It depends on the intention. Obviously, it is possible that the motor vehicle that you purchased met an accident, and then you had to scrap it off or sell it off very cheap within 1 year, but still it is your non-current asset because your intention was to use it for more than 1 year. Okay, it depends on the intention. Erasing this and moving on. Types of liabilities. Again, we have two types, very easy and straightforward. Current liabilities, these are those loans that you have to pay within 1 year. Loans to be paid. Loans or the money you owe to someone which you have to pay within 1 year. Within 1 year. Okay. And non-current liabilities are those loans that are to be paid after 1 year. After 1 year. Which year? Accounting year. Okay, it can be any one accounting year. So very simple and straightforward, nothing tricky in this. Loans that you have to pay within 1 year are your current liabilities. The most common example of current liabilities, one second, let me fix this because I am not able to write properly. Okay, so trade payables. These are those people to whom you have to pay back money for the goods that you have purchased from them on credit. Okay, this is a very common example of a current liability. On the other hand, a non-current liability can be a bank loan, which is, let's say, repayable after 2 years, 3 years. Repayable 3 years. Okay, so this is a non-current liability. Simple, straightforward. Let me erase this and move on to the next slide. Activity 3. State how each item would be classified as an asset or liability. Now we also know what non-current assets are and current assets are, and what non-current liabilities and current liabilities are. So we will also specify that. Buildings and property. It is a non-current asset because our intention is to use them for more than 1 year. Machinery again is a non-current asset. Trade receivables are our current asset. These are those people who owe us money and we expect them to pay us within 1 year. Trade payables are our current liabilities. These are people who have provided goods to us on credit and they expect us to pay within 1 year. Overdraft. Okay, what is an overdraft? This is a bank overdraft. I don't think I've discussed this before. So bank overdraft is simply a short-term loan from the bank. Let's say you went shopping, you had only $200 in your bank account, but you wanted to buy something which was worth $500. So your bank allowed you a short-term loan. Even though you had just 200, you were able to buy this thing worth $500. So now you owe the bank $300 because you are in negative in your bank account. This is a bank overdraft and you have to pay this back to the bank. So this is also a current liability because you have to pay this within 1 year. Cash in hand is a current asset. Loan from a friend is usually a current liability because friends don't allow a loan for more than 1 year. You know that. But it might also be a non-current liability depending on when it's payable. But for now, let's keep it as a current liability. Inventory, we know, are the goods that we buy to resell. It is a current asset because we expect to sell them within 1 year. Motor vehicle is a non-current asset, and equipment is also a non-current asset. So this is how we fill these and identify these. That's it for this chapter. Let's look at the objectives one more time and see if we have covered everything. Explain the meaning of assets, liabilities, and owner's equity. I hope you know in detail what they are now. Explain and apply the accounting equation. I have told you the accounting equation, which is assets is equals to liabilities plus capital. I have also showed you the impact of transactions on the equation and the dual impact of each transaction on the accounting equation. So that's covered in detail. And outline the double entry system of bookkeeping, which again is showing the double effect of every transaction on the accounting equation. So we have done that. We have just outlined the double entry system, but in the next chapter the double entry system will be covered in detail, and it is a lengthy chapter. So if you want to know about that, switch to the next video right now and we can continue from there. That's it. Thank you so much.